All right. Hi, everybody, and welcome to the very first Onvisor podcast. I'm joined by my friend Mathieu Roy from Louisbourg Investments, VP of Equities. And for those of you who don't know what equities are, they're another way to say stock. So I've worked with Matt for years. Louisbourg, I still work with them closely. And today I'm bringing Matt in to talk about investment markets, Louisbourg as a firm. We'll talk a little bit about how we still work together, and we'll dive into economics, investment markets, and so on. So, Matt, maybe let's kick it off by tell us a little bit about Louisbourg and what it is you do there.
Sure, no problem. Great to be here, Marcel. Louisbourg started in 1991. We were 2.5 billion in AUM, and we manage money for institutional investors. And when I say institutional investors, it could be pension funds, foundations, for example, insurance companies, and high net worth individuals.
Right.
And in both cases, we're trying to help people attain their financial objectives. So we manage money, we have financial planning, we help investors with their financial affairs, essentially. We're based out of Moncton, but we have an office in Halifax. We've had that office for some time. And over the last few years, we've also added a presence in Montreal and a presence in Vancouver. So oddly enough, anywhere but Toronto.
Yeah. So far.
Yeah, so far. Yeah.
I mean, Montreal is new, right?
It's getting closer. Yeah, it is.
Montreal's new, yeah.
A small acquisition in Montreal.
Yeah, good, but still nice to have a presence. Nice to be added at the back of the website there, the contact us page. And I mean, for a little bit of background, where I met Mathieu, I worked with Louisbourg Investments for about 6 years as a financial planner, and I really enjoyed it. After a brief period away, I kind of chose the independent path. I wanted to kick off Onvisor, and Louisbourg, to their credit, I guess, kind of opened the door to keep the people who wanted to keep working with me but remain invested with Louisbourg. We kind of came to an agreement, a referral arrangement, I guess. And what is kind of cool that I'm telling clients is that this is a pilot project that you guys have been wanting to get off the ground for a while, right? So I remember kind of telling Luc, why wouldn't we kind of kick things off, and why wouldn't I be kind of try to spearhead this and see, let's get the forms done and let's get the program off and running. Internally, how has it gone? Has you guys had any success? Has there been any traction beyond kind of kickstarting it with my book? Or
yeah, no, it's starting, and I think it's a good program. The idea is, everybody has their strengths, and you have people that can spend more time with clients, more on the planning side, where we're very strong on the investment management side, and we've had good success with managing our strategies, and it's a way for more people to be exposed to them.
Yeah.
So I think it's a win-win.
Yeah, absolutely. I think it's fantastic. And, my story, not only when I joined Louisbourg, but also since kind of going independent, and explaining why I still would recommend working with Louisbourg, is because I've always had an issue with somebody wearing too many hats. We've all come across these professionals in our industry where they are the portfolio manager, they're the insurance advisor, they're the planner and everything. And it can work, but it can't work at scale, right? It can maybe, but I think, and for my own practice personally, I really enjoyed spending time with the client, doing the planning, because sometimes you end up, being as much emotional support as you are financial guru. And I really appreciated when I joined Louisbourg that I could rely on you guys and the team to do the under the hood investment management. And all I really had to do was kind of do more the high level asset allocation at the time. And even now, taking a further step back and having a relationship manager in between kind of myself and your team, someone like Jeremy or Mike Moores, is great because it's great for the client. It adds layers, which is not necessarily my first choice, but in this case, it doesn't add to the cost of the client, which I feel is fantastic, right?
Mm-hmm.
So,
Yeah.
like you said, win-win, and super happy to keep working with you guys. So, a couple topics of conversation I wanted to address today. So today we're going to run through a couple of general questions I think investors have,
Mm-hmm.
and I just kind of like yours and or your team's take on it. I know you guys have just put out your market update for kind of the last of the year / beginning of 2025. So I guess let's start with economically, like from 10,000 feet. What would be the investment landscape as we see it kind of right now?
Sure. I mean, if you think about essentially the last year, maybe even 2 years, what everybody's been watching is, can we bring inflation down? Can we execute a soft landing? So central banks essentially were raising interest rates to slow down pricing in the economy. The economy was overheating to a certain extent.
Yep.
That put some pressure on prices. So central banks were trying to ease that off without essentially killing the economy.
Mm.
And the cues they were looking for was inflation coming down so that they could stop raising interest rates and start bringing them down.
Right.
And what really started happening in late 24 was we're reaching that objective.
Mm.
And we've now been on a path of reducing interest rates.
Yep.
And essentially, equity markets and markets overall have been cheering this.
Yep.
When you reduce interest rates, you stimulate the economy. So
Yeah.
the main concern that investors had was, we're going to raise interest rates to kill the inflation, or we're going to kill the economy, and then the stock market, as alongside of it.
Yeah, totally.
But really, we were able to execute that, and we've had a couple of very strong years in the equity markets.
Absolutely.
As a result. I think the concern now is, so we have the U.S. essentially runs the world, or is the
leader.
Is the principal actor.
Yeah, absolutely.
Has a lot of influence. Typically, Republican or business-friendly administrations are good for the stock market because people assume that it's going to be easier to do business. So
Yeah.
you have that one side of the equation.
And the stock markets benefit from that.
Yes.
Obviously.
And the other side of it, though, is the approach that Trump is taking right now is talking about tariffs, essentially negotiating pretty hard with a lot of countries,
Mm-hmm.
a lot of it happening at the same time.
Yeah.
So I guess the concern that I have, and the rest of the market talks about, it's not really happening in terms of how the markets are reacting, though. The markets have remained strong, but
Yeah.
the concern is we've been fighting inflation for the last couple of years.
Mm-hmm.
Looks like we're winning, or we're getting close to winning.
Yeah. There is light.
Yeah, if you put all those tariff measures in the process,
Mm-hmm.
essentially creating friction with other countries, raising the price of goods coming in.
Yeah.
That doesn't help the inflation.
That's right.
Numbers coming down.
The headwind, really.
Yeah. So is it? We were talking about I think way back I've been doing this for a long time. We talked about the double dip a while back. Now, in my mind, do we double dip on inflation, or so there is a concern that, and the last few inflation numbers haven't been great. And now could be seasonality, et cetera. But I'd say those are the two main things. If you think about the big picture of the market was bringing inflation down, which happened pretty well. Now is can it stay down with all of these things happening with a new administration in the US?
It's definitely, to say the least, interesting times. I mean, you have a lot of investors, paying attention. I think investing and self-directed investing is more accessible than ever. And have you, as an a portfolio manager, have you seen any changes in stock market, particularly sensitivity in the last decade, just because, this kind of influx of, I'm going to call them amateur investors or day traders, if you will?
I'd say in general, yes. I mean, I think there's two things. There's a lot more participants that are a little more momentum driven.
Yeah.
So it crowds out a little bit some of the, in the short term, guys like me that are bottom up, buying companies, very fundamentally driven, very valuation driven.
Yeah.
So you have a little more of that short-term thematic and momentum happening in the market. So what that means is it accentuates, it exaggerates movements, typically in the short term and the in the short term, so to the upside or to the downside.
Right.
So generally, I've seen that happen over the last decade or so.
Okay.
I'll be honest though, like I'm a little surprised. I think maybe I shouldn't be, but a lot of what you hear is a lot of people concerned about essentially what Trump is doing, but that's not happening in the stock market.
Right.
The markets seem unusually calm, and perhaps that's reflective of the momentum that maybe smaller investors react more to. So if you think about the last 2 years in the stock market, they've been exceptionally strong.
Totally.
So even if you have like near-term concerns, your recency bias could be that buying is positive, buy the dip every time. It's worked for the last 2 years or so. So
absolutely.
So I think you still have that phenomenon in a way.
Yeah.
For us, it's a little bit of the concern too. Markets maybe feel a little complacent with what's going on.
I could see that.
I never want to sound too overly cautious, or I've rarely been accused of it too, because being an equity guy. But I think one of the biggest mistakes investors can make is being too cautious and wanting to be out of the market, because right now is a good example of exactly that. It's difficult to predict what markets will do short term. You get concerned on Trump, but the markets are more excited about rates are now lower. There's going to be less regulatory hurdles to build projects. So it's difficult to gauge in the short term. And if people go too far, stepping out of the way or getting concerned, and then markets keep going and they're up 15%. So when do you buy back?
It's almost like people have kind of, I think there's a side of complacency there for sure, like recency bias. I think a lot of that's at play. A lot of talk, little action so far. But also maybe people are learning, like, market timing is not necessarily the answer. I know that, when I get calls of like, I've had a couple recently about, should I like move towards bonds or should I reallocate my portfolio? I'm getting antsy. And I'm like, don't forget, in order for this to work out, you have to make 2 calls right. You have to get out, before it falls, and then you have to make a good enough call, to catch it on the way up. So it's like you have to catch 2 falling knives here. You really want to make that bet. And, maybe people are catching on that is a thing. But I think complacency, recency bias, and just the general sense that people are going to, upswings are going to go further up than maybe they should, or, nobody really knows what tomorrow will bring. But so talking about that, on that lane of diversification, have you guys been doing any rotations in your portfolio, any asset allocation, tactical changes in your kind of internal portfolios that have been more recent given the environment we're in?
Certainly. I mean, there's 2 big legs. So it's starting with the asset allocation leg. I talked about it a little already. So you never want to become too defensive, because really, being long equities forever has been
it's the play.
It's the right strategy, right?
Yeah.
But 100% equity is not the right allocation for most investors. For a few,
Yeah.
you know, you have if you have a massive time horizon, you can take on a lot of volatility. You can be 100% equity.
I mean, for some people, that is,
Yes.
that's what they want and need, and that matches their goals.
Yeah.
But for most,
But for example, for maybe a balanced growth client that would have typically 70% equity, in today's market, we would probably have that client at 68 or so. You know, things would have gone very well. The markets would have brought his allocation to 72, 73, 75%.
that's right.
Essentially, we've taken a little bit of profits and we brought it slightly below
Yeah.
what would be the average allocation to equities.
Go from over allocated to under allocated.
Slightly under allocated.
Yeah.
And part of the reasons, there's some concerns in the market. You never know which ones are going to play out near term. But the other thing is the alternative, cash, short-term bonds, regular bonds, which is essential most of the time is your the other side of your equity allocation, your safety, is paying a lot better than it has over the last 10 years or so.
Absolutely.
Because rates have moved up a fair bit and we've come down, but they're still offering some pretty attractive returns for the risk.
Compared to before too, right? Like
Yeah.
a lot more attractive than before.
So your bond component or your fixed income component could be 4 or 5% expected return. Whereas not that long ago, you were getting maybe 2 if you're, from that asset class. So being slightly underweight equity, in case we get a little more volatility, which we want to take advantage of and buy, you're getting paid better than before to wait.
Yeah, totally. Absolutely.
Yeah.
The bond, or more, let's call it more defensive component of a portfolio is a lot more attractive than it was, let's say 3 years ago, or et cetera. And for those who are maybe a little less versed with these terms, equities are shares in stocks, so they tend to swing up and down a lot more. That's called volatility. Versus bonds are a little bit more like you're lending to companies and governments, and you're getting paid to lend your money as an investor. And because it's a loan as opposed to a cut of the profits, they tend to fluctuate a little bit less. The way I explain this to investors all the time is kind of like I started sailing not too long ago, and I'm like, stocks are like your sail. They're the only way you're going to get from NB to PI any reasonable amount of time. Just like stocks are the same, like they'll only get you to your goals in a reasonable amount of time. But bonds are like the weight, the keel underneath the boat that keeps the ride a little bit more smooth. They won't really get you across the pond that fast, but they'll make the ride a lot smoother. And to have those kind of pay right now, I think is a great position for, balanced investors, older investors who might want to take less risks. So yeah, definitely appreciate that insight. That rebalancing, it's probably a good time to rebalance, take some profits from the stock component and reallocate to something a little bit more neutral that still pays a good clip, right? Yeah.
Yeah, I mean, and you mentioned asset allocation, but also within the strategies, we're active and, the markets are volatile and offer opportunities all the time.
Sure.
A few of the things that we've done as of late is, trim a little bit of the Canadian banks, which are great long-term investments, but they grow at, 6% EPS or earnings per share per year, and they pay you a nice dividend. So, but you can trade them because when the markets get overly enthusiastic, the market will pay more for those earnings.
Yeah.
And then when the markets get concerned that we might go into a recession or just profits are going to be crimped for some reason, the markets will pay a lower multiple. So we've taken some profits from some of the banks. We don't think they reflect the tariff risk. Whether it happens or not, it's not reflecting it. So we felt it was a good place to take a little bit of money off the table. And there's opportunities elsewhere. The energy sector is attractive. Grocers in Canada, I think, they're running very well, lean operations, and we could get a little more food inflation in the system.
Sure.
Which I'm not hoping for, but if we're going to get a lot of tariffs and our dollars is weak, so we're buying fruits and vegetables from the U.S., it has an impact, and food inflation is improves their profits.
It's gonna play into this overall scenario for sure.
CN Rail would be a good example. The cat dealers in the industrial sector. So those
Right.
have been moves we've made where essentially buying companies where the outlook is pretty good, but maybe the sentiment is not quite as good in that sector. So the market's not paying a lot for those earnings, and that can change on a dime. One
Okay.
good quarter, two good quarters, and you can get very strong returns of the stocks of very solid businesses. So those are a few examples of things we've done in the portfolio recently.
Nice. Have you, just out of curiosity here, have you guys done any larger acquisitions or moves? I remember, Shopify being one when I was there. And I remember before when I got on, Facebook was a really good strategic one that I was impressed with. Have you guys in the last 6 or 18 months done anything more thematic, similar to those?
Yeah, I wouldn't call our team very thematic. It always plays a part because you have to know what's going on in the world. So it's got to be a good company first. But to your question, I think one kind of fits that bill is Tourmaline, which is Canada's largest natural gas producer. Nat gas has been a beaten up commodity for some time. Essentially because we don't have the ability to sell it wherever we want. We don't have the LNG facilities. We can't sell it to the right hubs in terms of where the price. Essentially, there's an oversupply of nat gas in the area that we're in Western Canada. Bottleneck, exactly.
Yeah.
And we haven't had governments a lot of willpower to build pipes, etc., to bring it to the right markets,
Ports, whatever,
LNG, etc. So I think a lot of those things are happening at the same time. First of all, because of that, there's been an undersupply of the commodity. People have not been drilling it because it doesn't pay as much in Canada.
Yeah, right.
So supply has been, pretty reasonable.
Yeah.
I think there's an appetite now to build LNG's coming to a certain extent already. We know that's happening, but I think there could be more.
Yeah, I think there's a big production like in Squamish right now.
Yeah.
Huge facility.
Exactly.
Happening. Yeah.
So there's going to be a push for LNG. So all those nat gas producers are going to find markets where they get paid more for their nat gas.
Yeah.
So that's one thing. That's just keeping nat gas status quo.
Like the supply.
Yeah. But if you think about all those plants all those data centers we're going to be building everywhere, and that's going to keep happening. I know there's, people question the speed, how much, but it's still going to be a lot.
Yeah.
And you're going to need a lot of electricity. And people talk about nuclear and uranium, and I think that's going to happen, but that's probably going to happen in 10 years. That's going to take a long time.
Yeah.
And everybody's getting more comfortable with nat gas. It's kind of it's pretty green. It's
reasonably green.
It's reasonably green.
Yeah.
And so the demand for nat gas is also going to go significantly higher. So I think you have all the ingredients here for, I think, I think even if nothing happens, I think that's going to be a good investment.
Yeah, it's just a solid investment.
But if those predictions happen, it could be a great investment.
Yeah.
And we already had some investments in that sector with Birchcliff, but we've ramped up.
Okay, all right.
Size of
kind
investment. Exactly.
Doubled down, if you will.
Exactly.
Okay, sweet. So I guess one other thing I thought might be interesting to talk about. Anything that you guys have your eye on or that you're keen on when it comes to kind of new emerging technologies, AI, for example, etc. How do you feel technology comes into play in kind of not in investment markets particularly? Like I'm not talking about AI bots and trading and all that stuff, but how companies and management teams will embrace technology and how that might work its way into bottom lines and profitability going forward.
It's interesting because you can maybe what's different now versus 25 years ago, and I make the reference of 25 years ago, essentially when the internet was invented or close to.
Sure.
It wasn't established companies coming up with these things, right? You remember, some of us will remember like Netscape or Alta Vista, and those were the thematic names that, in essentially, the pioneers. Yeah. But they didn't end up winning, right? There was a few winners, but it became the Microsofts and the Googles, etc.
There's clear outliers.
Yeah. But today, I think this is another internet moment. And I think, but it's less clear who's going to be the winner or if there's going to be any winners. I mean,
Current winners.
one big winner. Yeah. So the difference versus then is you have all these massive companies, established companies, gorillas into space, all investing massively in the space.
Sure. Yeah.
So that's the difference. So you have all these guys, and they're building things. They're building the capacity. Is one of them going to come? Already a very large company going to come out as a clear winner in the space, or is this going to be? They all build it. It drive. You have all these products and this capacity, this compute that everybody has access to. Everybody becomes more productive.
Yeah.
All these companies have access to the data. Essentially, is it possible that the winners become everybody else? So they all build it,
and then you have like a Zoom or like kind of random people who own some
exactly. So
a market. Let's
so
say.
we invest in some of those businesses. They're very strong businesses. We agree that they should be investing it. And I think they're going to be fine. But I'm a little more excited about. People that are going to be using the technology. Like if you think about everybody wants to use AI to reduce costs or to upsell their products.
Totally.
And I think that's happening. It's really difficult to see if there's going to be clear winners, but I think as a investment community and as a population, it's exciting. It can be scary too, but it's exciting because I think for sure we're going to become more productive. It's even all of us, I'm sure, have examples of, and if you haven't done it, try it, using ChatGPT to whatever task you're thinking of.
It's incredible.
It's incredible.
Like what it can do, like uploading documents, generate, like it's done a business plan for me in 5 minutes. It's incredible.
So think about everybody starting to use this en masse in all of their jobs.
Yeah.
I think that's that's the thing I'm pretty sure is going to happen.
Yeah.
In terms of if one company is going to come out saying like as a big winner.
Hard to say.
And then coming back to, I should have mentioned it earlier when you say like big themes in the markets, that's a fair kind of rebuttal of why not be so concerned, right? So you have these concerns about tariffs and maybe you bring back inflation, but at the same time you have all these massive investments happening that's probably going to bring productivity.
I was going to say
higher,
ultra productivity,
and have a lower, some impact on costs being lower. So,
totally,
it's also an exciting time from that perspective, and I can see the enthusiasm.
Even as a at this point solopreneur, I use AI as much as I can. It summarizes my calls. It logs in on my Zooms. It summarizes like all the places where I was a bottleneck, have now, I don't want to say become irrelevant, but it's helped me, scale myself. And I think larger companies are going to kind of tap into that just like they tapped into virtual meetings and everything. And I think, it's going to accelerate productivity within organizations. And I think the ones who invested it correctly with the right people are going to benefit, when we're talking about larger organizations such as, let's say, Meta or, Google, et cetera. Exciting times for sure.
Yeah, I mean, all these companies are investing massively into it now and have been, but we've already been using ChatGPT for over a year. So even at the, we're at the very early phase of this.
Yeah.
And it's already being pretty helpful. So
it's impressive.
It's pretty exciting.
Yeah, it's pretty wild times. I'm actually reading. I just started reading this book, and it's been recommended to me a lot. And I guess he has two. It's called *Sapiens*, and it's a brief history of humankind. Okay. But even at the start, he's also already talking about superhumans that is not that far off from now. Like that, the intelligence and the technology is going to literally create a whole new version of humankind that's just gonna kind of overshadow what we know as human beings and our brain and calculating. So like the acceleration, the exponentialness of technology and like supercomputing and stuff is quite remarkable.
It is.
Yeah. Okay. Well, the last thing I wanted to talk about, it's hard to talk about investing and wealth creation in general without talking about real estate. So you guys have a new, relatively new, I don't know, how many years now, the Generation Fund?
I think it's probably a little over 2 years.
Okay. So maybe talk to us a little bit about the Generation Real Estate Fund and what you guys have been up to in that space, and maybe touch on maybe real estate in Atlantic Canada in general, what you guys have been seeing and why you're considering certain things or avoiding certain things in that space.
Sure. I mean, just as a bit of a background, we created the Generation Fund, which is a partnership with Zupac. So we kind of had the investment knowledge. They had a lot of the real estate knowledge. And the idea was, I mentioned earlier, like you have your growth asset class, which is equities, which is volatile, is priced every second.
That's right. Yeah.
But you know, historically, it's growing at 10% or so a year, compounds every year. You have ownership in the business, and then you can lend money with fixed income.
Yep.
And you'll get a lower return, but less risk.
Yep.
And less volatility. For a lot of clients, adding real estate is somewhere in the middle. So maybe a client doesn't want to have that much fixed income, but doesn't want to overextend himself having too much equity. We carve out a slice and we invest in real estate.
Yep.
And some people invest in real estate themselves, and that's great.
Yep.
But not everybody has the ability to invest the amounts necessary.
Yeah, totally.
Or the skill or investing in real estate is a lot of effort.
There's a barrier to entry. There's a significant barrier to entry for sure.
Even on an institutional side, it's there's a lot of hoops to jump through to buy a property and to run it.
Yeah, I imagine.
But that's the reason. So essentially, we're aiming for return somewhere in the middle, with little volatility
and fixed assets.
That's attractive for clients. Essentially, you're buying a piece of real estate. And it should be inflation protected to some. If you're invested in the right areas, rents should keep up with inflation over time. So the market values of your properties go up alongside of that. And it's relative. We probably have maybe over a dozen properties.
Okay.
And we focus on properties where we feel that it's service oriented, has very little chance of going elsewhere.
Right.
It could be a bank branch that's already in the community where there's only one.
Like long-term tenants.
Long-term tenants.
Yeah.
Could be drive-through restaurants from a national chain operator.
Yeah.
And we're looking for longer leases in good areas where we feel comfortable that even if something happens and the client would go elsewhere, that we would have no problem in leasing that. Exactly. So we're right now we're only in Atlantic Canada. I think we're New Brunswick and PEI. And it's a combination of essentially retail, light industrial, and a little bit of multi-res.
Yeah.
That's the part it plays in a portfolio.
Yeah. Okay. Well, that's awesome. Like, I really enjoy that you guys have made it definitely more accessible. And the other thing that makes the Generation Fund attractive, I remember when I was talking to clients about it, is the portfolio accounting. Like, basically you simplify all these properties and the fees and the costs associated to them, and you break it down to a line item on your statement. A lot of other, let's call them REITs or operations that are taking money from investors don't necessarily have a quarterly statement or a statement at all. You're kind of just trusting the books. And if you can't read the books, it's really tough if you don't know how to read a financial statement. So I think we're going to end it on that, Matt. I really appreciate you coming in. It was honestly a blast chatting and picking your brain. Any last things you want to add, or?
No, great initiative. I enjoy the conversation, and
Yeah.
hopefully we can do it again.
We'll do it again. Absolutely. All right. Well, thank you very much, guys. Thanks for tuning in. If you have any questions regarding this, Louisbourg, their services, or any financial planning advice needs, reach out on onvisor.ca or on social media. Be happy to help. All right. Later, guys. Cheers.